All right, everybody, welcome back to another episode of the Discovering Multifamily podcast. I'm your host, Anthony Scandariato with Red Knight Properties. And boy, do we have a great show for you here today. I want to introduce to you Mark Hamilton, who's going to be our guest today on the show. He's the founder of Hamilton Zanze, which is a real estate investment firm with a portfolio of about over $4.3 billion in AUM that specializes in primarily multifamily. His company is one of the nation's largest privately held multifamily syndication companies. He's got over 20,000 units under management. And Mark's really positioned himself as an expert. He's seen the ins and outs of all types of different multifamily investing. But one of the things that Mark's passionate about is the 1031 exchange tax program, what we're going to focus on today, and how Mark has been able to utilize that to grow his business and help his clients. So, Mark, thank you so much for coming on the show. It's truly an honor.
Thank you for having me, Anthony. It's a pleasure.
Great. So I guess let's just wind it back a little bit. What's a 1031 exchange and why is it popular in real estate?
So Section 1031, or the term 1031, refers to Section 1031 of the Internal Revenue Code, which has for more than 100 years allowed property owners who own property as investment or income property to sell it following certain guidelines and go out and purchase a replacement property and defer the capital gain that would otherwise be due at that time. Our research, which we've done a fair amount of recently, indicates that a typical investor will do that once or twice or maybe 3 times, but it isn't typically a strategy that people lean on for eternity. Some will go quite long with it and then end up putting their properties in their estate, but they're an outlier. It's about 85% of 1031 investors will do it a few times, do it twice, do it 3 times, and then ultimately cash out. But it allows them to defer the gains at that time. And it's a fairly commonplace practice, and yet I think it still mystifies many people because again, our research indicates that as many as 6 out of 7 people who open a 1031 exchange account, who open an account with an accommodator, won't end up completing their exchanges. And so it's utilized. It's not as fully utilized as it might be, and it from time to time, it becomes kind of a political football. That may happen now, that may happen this year or next year, it remains to be seen. But we did a policy piece recently that just got published last week. It was co-authored by CBRE and our research department, and it was directed specifically at the public policy aspects of 1031 exchanges and why they're good, certainly for investors, but why they're also good for the economy, why they're good for states and municipalities, and why they're even good for the Internal Revenue Service. So if anybody wants to look for that, you'll find it on the web. It's at Hamilton Zanze, and it's a 1031 policy piece.
Excellent. Well, we'll have a link to that in the show notes at the end. Appreciate it. Can you give us some of the highlights from that piece?
Of course.
Maybe 3 bullet points.
Yeah. Again, what we learned is that we already knew that many people who go into exchange accounts don't end up following through, and I think that's primarily because they just can't find something that they want or something that they're comfortable with. But we do know that very few investors take it as an ad infinitum strategy. It's a short term or an intermediate term strategy. And curiously, we know that 1031s are good for cities and municipalities because they lubricate the gears of property transactions, and property transactions generally generate transfer taxes for states and for cities and counties, and probably sometimes states. People who hold properties in exchanges tend to hold them for around 10 years. People who cash out tend to hold them for 11 years. And so right away, you get more transactional activity. Again, we believe it's good for cities and counties. But the other thing we discovered is that when an investor does defers the gain, they will go out and purchase another property, and while their equity presumably has grown from their last asset, the amount of basis that they have doesn't go up. And so in the end, it ends up generating more tax revenue off of the investor's income stream, although it defers the capital gain. But the capital gain, again, tends to get paid within 1 or 2 cycles of a 1031. So, it's a little bit counterintuitive, but we believe that it is accretive not only to cities and counties, but to the federal government. And we also know that it's good for the economy. There's a lot of renovation and repair that gets done on the acquired properties following an exchange that might not get done otherwise. And there's a very deep analytical paper. It's called the Ling-Petrova paper, and it's named after Professors Ling and Petrova. You can find it on the web, but they go into greater detail about the economic significance of it as a jobs generator. And so if it's generating jobs, it's generating payroll taxes. If it's causing investors to have more income that is not sheltered, again, that's generating more tax for the IRS and for states.
No, and I agree with everything you're saying. And the 1031 is not just for real estate, right, Mark? It's for many different types of asset class. I mean, you hear a lot about it specific to real estate, but what else is it commonplace for? What other types of transactions?
Historically, the 1031 in and of itself is about real estate only. Now, when we talk about exchanges, until 2017, there were other types of exchanges you couldn't do. Obviously, if you sold some stocks and bought some stocks, that's not an exchange. You pay the capital gain on the profit that you've made. But historically, you could exchange a life insurance policy for a different life insurance policy and not pay capital gains tax. And for many people who collected fine art for sure. I don't know about antiques, but people who collect fine art, they used to be able to sell their fine art and do an exchange. The provisions for other asset classes were taken out of the Internal Revenue Code in 2017. So right now, to the best of my knowledge, the only asset class that is eligible for tax deferred exchanges is real estate.
Okay, so yes, historically in the past, there's different asset classes, and I know that there are different mechanisms that actually are more popping up now, although they've been around. Deferred sales trust is one of them. If you had any experience with that and any thoughts on that?
Well, I don't know what a deferred sales trust is. Is it possible that you're thinking of a Delaware statutory trust, a DST?
Separate. They're two separate items. And we could chat offline about it, but it's another mechanism to, defer the capital gains taxes, but you're basically holding it in a trust instead, for a period of time. And then, they charge administrative fees on it. There's upfront fees on it. So you have to do the numbers and see if it makes sense. But I did hear that was very competitive to 1031. So, but regardless, the 1031 has been around, like you said, for a very, very long time as it's specific to real estate. Now that we have the new administration change, has there been any chatter in regards to any changes with the 1031 provisions? I know they had some that were income based.
You bet. So Biden made it quite clear before the election that he was going to shine a bright light on 1031s and look to either tighten up the rules or even possibly repeal them altogether. Last I saw in terms of specifics was that they would allow that they would be, how do I want to say it? They would be preserved for households making less than $400,000 a year. But if you have an adjusted gross of over $400,000 a year, then you wouldn't be allowed to defer the gain. At one point last year, there was concern that the Biden administration might repeal them altogether. It seems that the more recent approach has been to repeal the benefit for households earning $400,000 a year or more, and it just remains to be seen. There obviously is a very active real estate. There's a number of active real estate lobbies, but part of the reason that we wrote the paper is that we do feel like they're misunderstood. I think under Paul Ryan, the Republicans didn't have much interest in preserving the 1031. They just wanted to flatten the tax code or flatten the tax rates. And the Democrats do, of which I am one, do tend to misunderstand completely and look at it as a giveaway. What the 1031 really is a way to reward long-term savings for an interim period of time. You know, we do that with the capital gains tax. If it's short-term capital gains, it's one rate. If it's long-term capital gains, it's a different rate. And certainly savings that's invested in the communities and in the tax base is very important. But I do think that it's the two primary benefits of it are, again, that it rewards intermediate to long-term savings. And the other thing it does conceivably is allow people to bank themselves. If they can take their gains and redeploy them, then they might not need to take out as much financing on their next real estate transaction. And I think those are the two big benefits for the consumer. And they're, to my eye, they're fairly rational and commonplace.
Sure. So in your mind, if it does get completely repealed, do you think that in the real estate market, you'll have a lot less, sounds like you'll have a lot less transaction volume, a lot less, sellers looking to sell, and, it might even affect property values to some extent if it does
I think both of those things will be true. I think it will reduce transaction velocity, the number of transactions will fall. I think it'll be counterintuitive in terms of the outcome for the IRS. I think revenue to the IRS will actually go down. I think transfer tax revenue will go down, and I think property values will go down. And it won't necessarily benefit jobs. And it's just, again, I do think it's misunderstood from a policy standpoint.
Sure. And to be honest, okay.
And our paper, we took a really complex subject in terms of, or I should say, starting point, which is the Ling and Petrova paper. It's about 80 pages of dense economic material. And we took that and boiled it down to 10 points that I think are very plain spoken and easily approached by anybody who's curious with the subject. And it's composed 100% from the standpoint of public policy.
Excellent. No, that's great. So I'll definitely include a link to that in the show notes. And so and just on a personal anecdotal note, how has the 1031 enabled you to grow your business over your career?
And so my wife and I bought our first property in 1985, and it was kind of an all hands thing. It took the two of us and her parents and my parents to be able to get the thing airborne, but we did. And I will tell you that almost every transaction that I've touched, or every property acquisition that I've touched in the last 35 years has been with partners or fellow investors. So we have a lot of experience investing with other people and have completed probably 300 acquisitions over the last 35 years. It's been a good thing for me and for our organization, because it's allowed us to retain investors who wanted to stay in and go on to the next thing. And we've found out as we've gone that when somebody wants out, if we're in a partnership and somebody wants out, it's not hard to buy them out. And there isn't any gamesmanship or any clever tricks involved in that. When we close a sale, you can see exactly what the settlement statement showed. And you just buy people out who want out. You buy them out at their allocated percentage interest of the property or of the proceeds. So that part of it's straightforward. And, historically, 80 to 90% of people tend to want to stay in for a while. There was one thing that happened in the 2017 rules, and that was that under the old rules, if you had a partnership and 50% of the participants wanted out, then that was what's called a deemed liquidation. And you basically liquidated the partnership at that point in time, even if you had people that wanted to continue on. Under the new rules, they've repealed that. And so any number of people that want to stay in can stay in. Any number of people that want to go out can go out, and it doesn't blow up the partnership, and it doesn't blow up the exchange. But primarily, to your point, is it's allowed people to stay in and have and earn gains over a longer period before cashing out, and it's been good for word of mouth. As recently as 2001, when Tony and I became partners, we probably had a few dozen clients, and growing it just by word of mouth without any advertising, commission salespeople, solicitations, one thing or another, without any of that. Word of mouth has gotten us to a point where we have a much larger client base, and have been able to do bigger transactions.
Excellent. And a quick question on 1031. This is more for my audience. Is there a minimum limit for the 1031 you're able to defer, and a maximum as of right now, as it stands? There
isn't. Yeah. And curiously, the 1031 rules in and of themselves don't say how long you have to hold the property. For long-term capital gains, we're all taught that you need to stay in something for at least a year. To the best of my knowledge, and unless it's changed recently, you don't have a minimum ownership period. And so you can make a small short-term profit and defer it. You can make a large short-term profit and defer it. And what's required is that you have to replace all of your investment proceeds into the next property and into expenses that classify as if they're real estate. For example, if you use a real estate lawyer in your transaction, that would classify as a real estate cost. Commissions classify as a real estate cost. But you have to replace all of your cash proceeds into the next asset or more, and you have to replace all of your financing or more.
Right. So is there an instance where, you're trying to exchange? How about if you're trying to exchange to a greater property, like you just mentioned, or more, you have to come up with the difference in terms of the equity contribution. But how does that work if you want to do another exchange, or if you just want to flat out sell? Is it,
so typically,
what are you taxed on? Yeah.
So typically how we'll do that, we have 90 to 95 apartment communities that are presently in our portfolio. And at any given time, we'll sell a few of those in a calendar year, and then put the proceeds into an account with an accommodator, and then go buy another property. And so it's not necessarily easy to line it up perfectly, so that you have we refer to up legs and down legs. Your down leg is the property that you sold. Your up leg is the property that you bought or that you're buying. And needless to say, it's a rare instance where things line up exactly, where you have the exact amount of equity that you need for your up leg, and you're going to take out the exact amount of financing. Usually you're going to take out more financing. Usually you're going to put in more equity. And if you come in short on either of those, it does create capital gains exposure, which is referred to in this case as boot. I don't know who came up with that. But what we'll do when we go out and buy the next property, we always have people who want to continue to invest. And in many cases, we'll have clients who need to complete their own exchanges. So it's a little bit of a jigsaw puzzle for us on the up leg, because we'll take our partnership equity that we have from one or more properties that we need to put into an acquisition property. And then we'll also work with clients that we have who are trying to achieve their own 1031 gains, and you basically patch it together. And then if we need to add more capital, from time to time, we'll form another partnership entity that will also go on title. And from time to time, we'll resize the partnerships by allowing them to offer more shares, which, while it does dilute people in the partnership, it doesn't dilute them in terms of their percentage interest in the real estate, because that money would have been raised somewhere else.
Right. No, that makes sense. Has the timing, they haven't touched the 1031 provision in a long time. So has any of the timing still remains the same in terms of the identification period, et cetera, correct? And what is that
Correct.
Again for the
So
audience?
you have from the time you sell a property, which again we refer to as the down leg, the IRS probably refers to it as the relinquished property. But from the time you close escrow on that, you have to do two things. You cannot touch the money. It's called constructive receipt. You have to make sure that the funds go to a third party who's going to hold the funds. That person is a firm like that is typically referred to as an exchange accommodator or an exchange facilitator. So the title company will send your proceeds to an exchange accommodator. Then you have, from the time you dispose of your sale property, you have 45 days during which you must designate the property that you're going to buy. And there's some flexibility there. You have, under the basic strategy, you can designate up to 3 properties, but you must close at least one of them. You can close more than one, but you must close at least one. The only way you can get out of the 45-day designation mandate is to simply acquire your purchase property within 45 days. And then you needn't designate because you've already done it. After the 45 days, you have another 135 days to close your purchase. And there are no exceptions. The only time I've ever seen any flexibility in that was last year during the pandemic, because the financial and real estate markets were upside down. They did extend some of the dates, but people should assume that those dates are hard and fast. So sell your property, 45 days, designate 3 properties, another 135 days or less, you purchase your exchange property and you're done.
Right. So have you ever run into a timing issue throughout your career?
You can easily get into tight timeframes, but no, we've never been outside of those dates. And because we're constantly in the markets, and this is what our organization does. We're very on top of it. We know how to make sure that we're going to be able to cover our bets, and we do that in large part because, given that we always have a demand to buy things for our own partnerships and for clients, we're constantly looking for property. We'll take in 3,000 to 4,000 submissions a year. We'll underwrite 200 to 250. We'll write 50 offers. And, in a good year, we'll get 15 to 25 assets. And so we know what our deal flow looks like. And so it's much easier for us to mind our P's and Q's on our timelines. But sometimes you will run into an investor who doesn't quite understand it, or who gets late in the game. And nobody's happy when they're late in the game, because you worry about blowing your exchange. But if you're doing it on your own, or if you're doing it with a service provider like us, you want to make sure you get in the game early, right? That you engage early, that you spend plenty of time, even before you put your property on the market. But certainly while it's on the market, you need to be working with the people who are going to help you complete the exchange. And we generally recommend that sellers build some extension options into their sales agreements, so that if things are a little tight in terms of timing, they can extend the closing date on their sale by 30 days or 60 days. And it generally becomes less stressful if you spend more time up front.
And that makes sense. You usually have to have the buyer agree to it, which, to be honest with you, a lot of buyers do agree to it if I was trying to buy it.
Well, it's a seller's market right now, and it's been that way for a while. But, a buyer, in the old days, the buyers were the ones that wanted time, because they were the ones that were going to scramble to put their equity and put their financing together. These days, it's not uncommon for the seller and the buyer both to see some benefit in having extension options.
Right. No, that's excellent. So when you sell your assets, and I know you don't sell often, but when you do you always do the 1031, or has there been?
Almost always. I would say 90 to 95% of the time. I can only think of 2 properties that we sold where at least one of the partnerships didn't continue. And one of them was because there was an investor who had a very significant position in one of the partnerships, and needed to cash out to reconcile some matters with his family. And so we just liquidated that partnership. The rest of the ownership entities traded forward. And then we had another one where we didn't make all that much money. We made some money, But we didn't have, it wasn't wildly profitable. And there were people who were content to get their money back. So we just liquidated that partnership. But I would say better than 95% of the time, we're going to do a 1031.
Awesome. Well, to find out more about 1031s, how could people reach you, Mark, and to learn more about you and your
So
company?
the Hamilton Zanze website is actually a good website. It's user friendly. It speaks to the subject matter easily. Again, we will be putting out, and the paper did post last Thursday. But otherwise, I'll be happy to give you my email.
Sure.
And that's MARK at Hamilton, HAMILTON, Zanze, Z as in zebra, A, N as in Nancy, Z as in zebra, E as in Edward.com.
Great. And we'll have a link to your email, as well as if I have the ability to post a PDF of your of the piece in the show notes, or a link to it, I will do that, as well as the Hamilton Zanze website, which I went on before, and it is beautiful. It's pretty easy to use. So
Yeah, it's pretty easy to look at.
yeah, so definitely check that out. And if you liked what you heard and or saw today, please give us a review and rating on iTunes. It'll help Mark and my message get out to a greater audience. That's just the way it works. So we would appreciate that.
Well,
And
we're traveling again, so maybe we'll have a cup of coffee in New Jersey at some point.
that would be great. I'd love to have you, and love to have you back on the show.
Great, Anthony. Thank you. It's a pleasure.
Thank you.